This question is from Drew Boots. Question is, I retired at 46. I'm now 58. My portfolio grew by almost 2.5x during those 12 years of retirement. Awesome. You should probably take my job. I'll let you answer the question next time. That's fantastic. Congratulations. It's a good time to be a retiree. I'm doing some Roth conversions now to add that third bucket of income to manage taxes. But the question is, could simply not investing as aggressively in a traditional IRA reduce the need for Roth conversions now and save opportunity costs of paying conversion taxes now from taxable brokerage to avoid larger RMDs later? Most models assume dividends and cap gains are always reinvested in stocks versus a money market in traditional IRAs. But what if dividends and cap gains are directed to money market fund within a traditional IRA? So traditional IRA growth slows gradually as traditional IRA composition goes more conservative. Yes, effectively, I live paying taxes on Roth conversions now, plus that money is gone and cannot compound, and I may never live to spend the Roth. However, if I do not invest my traditional IRA dividends and cap gains in stocks, this is a long question, so I'm actually going to cut a bit of it off. What are your thoughts? I mean, this is an interesting, so effectively what you're proposing, and then I'll come back to your question, is basically what we call a glide path. It's a gradual shift in asset allocation as you age that reduces growth exposure to higher growth buckets or investments. And you're talking about doing it in a strategic way in specific account types, such that the account type that is, let's say, tax disadvantaged in retirement, I don't know, that's probably not the right way to say it, ends up with a glide path that reduces how much it will grow, whereas other accounts end up with the glide path that increases its exposure to growth related or growth opportunities. And so the accounts diverge. I think, so not advice. Nobody should go out and do this without more context about their individual strategy, whether RMDs and pre-tax money are an issue or not. Like, I think, again, diagnostic first, action second. One of the worst mistakes we make in life across everything is action first and then diagnosing second. Bad idea. Leads to tons and tons of bad outcomes. So with that said, this strategically is a viable thing to consider in the right circumstances. I like it a lot. There's trade-offs in terms of execution and complexity, but sometimes that's worth it. The truth, and this is, I think, I don't know, a truism. It's not true, but it's an opinion, but I think it is, broadly speaking, correct. Most people don't like to pay taxes. Roth conversions seem attractive when we watch them on videos, but when we actually come to the point of executing and prepaying taxes now for an uncertain future benefit, it's a lot more painful. The rubber meets the road. It's, again, like, I'll run a marathon, or I'm going to tell my wife I'm going to run a marathon, but then, like, will I actually sign up for the marathon training? It's painful and annoying, and it's a pain, right? So I think your point is well received there. And are there other ways to achieve a similar objective? Can we minimize future RMD risk? Can we minimize future tax trap risk? Maybe. We can do that in a couple ways. We could probably change an asset allocation glide path. That would be one viable method. We could do pro rata withdrawals, where we withdraw pre-tax money earlier in retirement, even though that would not technically be the right sequence of withdrawals according to many financial planning softwares, but it can be a viable strategy. And I think I've shown some simulations of that online. So, without giving you like my permission to do that strategy yourself, because I don't know what your specific case is. Again, saying this is not advice. It's an interesting and viable strategy, probably in certain cases, if the pieces all come together properly. I have a video on my YouTube channel, on the main channel, where I talk about reverse glide path. I don't remember the name of the video, unfortunately, but maybe worth looking into a concept called reverse glide path, because that is kind of what you're talking about. But what you'd be talking about is a reverse glide path applied at the actual tax account level. So it's like an extra layer of specificity, but interesting idea. Great question. Great comment. Thanks for the comment, Drew Boots. Thanks for the support of the channel. Real quick, let me show you the exact 3-pillar comprehensive retirement roadmap that takes retirees from uncertainty to peace of mind that less than 1% of retirees actually have in place. Now, I've built hundreds of these for retirees, and I can say with a high degree of confidence that these are the 3 pillars every retiree needs to have in place in order to have full confidence that they're not missing anything in their retirement plan. And I broke each of these down by the specific questions. You can see them here that each needs to be answered and the best way to answer them.
Now, we've done this across pre-retirees, recent retirees, married couples, single retirees, $1 million portfolios, $10 million portfolios, all the above, and it works. And it's my gift to you today. It's absolutely free. It's in the first link in the description below this video. It's going to say free comprehensive retirement roadmap training. Just click the link, enter your info, and you'll get instant access all for free.